There are lots of investors who know when to enter the market, what type of investments to make, and what to choose, but very few of us know what is the right time to book profits from the mutual funds. While there is a lot of discussion about the right time to enter, very few talk about the exit strategy. But if you want to make good returns on your mutual fund investments, then you should always have a profit booking strategy. Let us see some of the strategies to book profits in mutual fund investments. P/E ratio. The price-to-earnings ratio is the ratio for valuing a company that measures its current share price relative to its per-share earnings, EPS. The price-to-earnings ratio is also known as the price multiple. This ratio can be applied to equity markets to check its overvaluation or undervaluation. Long-term average P/E is around 20. P/E ratio moves in a range of 11 to 29. So whenever P/E ratio is more than 20 and moving towards 29, then market is said to be overvalued. Similarly, whenever P/E is less than 20 and moving towards 11, then market is said to be undervalued. So as per a good strategy, investor should always cut down equity exposure whenever market moves towards 29p, and he should increase equity exposure whenever market moves towards 11p. Investors can decide their own equity levels based on P ratio. Example: investor can have 70% exposure at 20p or 60% exposure at 25p and so on. P/B ratio. A financial ratio that is used to compare market value of a stock to its book value is called price-to-book ratio or P/B ratio. The financial ratio is derived by dividing the price of a share by the book value of a share. This ratio can be applied to equity markets to check its overvaluation or undervaluation. Long-term average P/B is around 3.5. P/B ratio moves in a range of 2.5 to 4.5. So whenever P/B ratio is more than 3.5 and moving towards 4.5, then market is said to be overvalued. Similarly, whenever P/B is less than 3.5 and moving towards 2.5, then market is said to be undervalued. So as per a good strategy, investor should always cut down equity exposure whenever market moves towards 4.5 P/B, and he should increase equity exposure whenever market moves towards 2.5 P/B. Investors can decide their own equity levels based on P/B ratio. Example: investor can have 70% exposure at 4 P/B or 80% exposure at 3.5 P/B and so on. Market cap to GDP ratio. The market cap to GDP ratio, also known as the Buffett indicator, is a measure of the total value of all publicly traded stocks in a country, divided by that country's gross domestic product, GDP. It's used as a broad way of assessing whether the country's stock market is overvalued or undervalued, compared to a historical average. This ratio can be applied to equity markets to check its overvaluation or undervaluation. Long-term average market cap to GDP is around 73%. Market cap to GDP ratio moves in a range of 50% to 125%. So whenever market cap to GDP ratio is more than 73% and moving towards 125%, then market is said to be overvalued. Similarly, whenever market cap to GDP is less than 73% and moving towards 50%, then market is said to be undervalued. So as per a good strategy, investor should always cut down equity exposure whenever market moves towards 125% market cap to GDP, and he should increase equity exposure whenever market moves towards 50% market cap to GDP. Investors can decide their own equity levels based on market cap to GDP ratio. Example: investor can have 70% exposure at 90 market cap to GDP level or 80% exposure at 75 market cap to GDP level and so on. Historical market cap to GDP ratio for last 15 years is shown in the figure. BER ratio. The bond earnings yield ratio, often called as BER ratio, is calculated by dividing the benchmark 10-year bond yield and earning yield of the stock market. This ratio can be applied to equity markets to check its overvaluation or undervaluation. Long-term average is around 1.5. BER ratio moves in a range of 0.5 to 2.5. So whenever BER ratio is more than 1.5 and moving towards 2.5, then market is said to be overvalued. Similarly, whenever BER is less than 1.5 and moving towards 0.5, then market is said to be undervalued. So as per a good strategy, investor should always cut down equity exposure whenever market moves towards 2.5 BER ratio, and he should increase equity exposure whenever market moves towards 0.5 BER ratio. Investors can decide their own equity levels based on BER ratio. Example: investor can have 75% exposure at 1.5 BER level or 85% exposure at 1 BER level, and so on. Constant weight strategy. A constant weight, also known as constant mix, is a strategic asset allocation strategy, which keeps the aggressive and conservative portions of a portfolio set at a fixed ratio. To maintain the target asset weights between equity and debt, the portfolio is periodically rebalanced by selling outperforming assets and buying underperforming ones. Thus, equity is sold if it rises more than other investments and bought if it falls in value more than other investments in the portfolio. The balancing can be done on monthly or quarterly or yearly basis. Investor can decide the optimal levels of equity and debt in their portfolio. They can decide the levels based on their risk tolerance, age, income levels, etc. They can also consult a good financial advisor for deciding the equity and debt proportion. Let us see an example where the investor decides 70-30 as equity/debt mix. So if we see the comparison between a normal strategy and constant mix strategy, then clearly the latter wins the race in long run. Because the final value is 129.21 for constant mix and 120.5 for normal buy and hold strategy. So it can be concluded that for getting the best results, a combination of above strategies should be applied to your portfolio.
So friends, thank you very much for watching the video. If you like this video, then please like, share, comment and subscribe for more investment related videos.